When it comes to investing, recessions make the most millionaires. This is according to our next guest, Kiana Danial, founder and leader of the Invest Diva movement. Welcome back to the show. It's a pleasure to speak with you.
Happy to be here.
Now, let's talk about that statement. Recessions create the most millionaires. What do you mean by that?
It's basically the biggest wealth transfer. Every time the markets kind of make a downturn, it doesn't even have to be a recession. It needs to be a huge market drop like what we saw back in March when COVID happened. And it happens almost once a year, but a recession, that is when the most millionaires are made. And the reason why is that all the newbie traders or the small traders who panic and sell off basically transfer all of that wealth to the people who keep calm and keep steady and buy the dip. And that's how it actually makes the most millionaires.
Okay, Kiana, so before we talk about your trading strategies and what you feel about stocks today, let's talk a little bit about the Invest Diva movement. What is this all about? What is the message you're trying to give to investors? And how did you go about accumulating wealth from basically, nothing because you started from the ground up to $1 million through trading? What can people learn from you?
So Invest Diva is basically a movement of, I founded it to be for women, but we have students who want to be in charge of their financial future and they want to make their money work for them. So I'm leading this movement for anyone who is scared to get in or has been trading and has lost a bunch of money to come in and create a strategy that is suitable for their risk tolerance. We go in from the personal finance angle and then we go into trading and investing strategies. And that's basically what it is.
Tell us what you would be teaching your followers what to do during a market crash like what we saw during March this year, for example.
Right. So actually, this March was one of our best months this year, actually in the past few years, is because we did something very, very simple. We didn't panic. We didn't sell the equities that we already had in our portfolio. Well, the matter of the fact is that we knew that the recession was due to come anyway, because it's just a business cycle. So we kind of were prepared for that. We had some extra cash in our portfolios. And when everybody was just panic selling, we were buying. We already had a list of the stocks that were perfect for our risk tolerance. Everybody is different, right? So my risk tolerance is different than yours. We have different financial goals. Like, for example, for my dad, I invest more heavily in dividend stocks. For myself, I invest more heavily in tech stocks. But regardless, when the market drop happens because of something crazy like COVID or a recession, everything falls, regardless of the valuation. So we already had the list and we bought as it went down. And it's been awesome because majority of the stocks that we bought actually now are back at an all-time high. And we've been just banking on that. So that is then. And I know that the next question, I'm going to just do this conversation with myself, is just can see this coming. Okay, so what now? Did I miss out, right? No, we didn't miss out.
Okay, so prices are high, but valuations are not the same thing as prices. Is that correct?
Exactly. I'm glad that you brought that up. So a lot of these assets are now at all-time highs, but that doesn't mean that they are still valued because they're actually now overvalued. So we have to basically shift our head and look at a different asset that is currently undervalued. That is basically what we're on the hunt for all the time. And more often than not, the undervalued assets are the ones that the newbie investors and traders who are just looking in, they don't know what they're doing. They're now selling. It's getting sold off. It's based on the FOMO and the hype of the media. I'm guilty of it too, but people just sell or they get hyped up and we go against that. So that's the way, like it really, what investing really needs is Zen, meditate, and don't fall for the hype and FOMO. That's really, really what it is all about. It's not about math. It's not about reading the company's numbers. It's only about avoiding to fall for the hype and FOMO.
All right, let's dig a little deeper. So I know that retail investors have a tendency to chase momentum. How can you tell if something is being chased up too high beyond its reasonable valuation? What are some of the signals you would watch for?
I look at market sentiment, right? Twitter, see if it's trending on Twitter, it's probably hyped up. I look at a variety of websites. I look at Seeking Alpha. I look at Morningstar. So Seeking Alpha has kind of different it shows you actually market sentiment. Is it bullish, very bullish, or bearish? Morningstar normally is very conservative. So I'm not as conservative Morningstar. So I kind of go somewhere in between Seeking Alpha and Morningstar when I'm looking at the market sentiment. And then I look at the price. The price itself, if you look at the chart, it's telling you a story. If you're seeing that, okay, the stock price was like this, and then now all of a sudden it's like, bzz, it's going up, it's probably hype. And that happens. So for example, with Tesla is one of my favorite stocks to not hold, even though like I'm a huge fan of Tesla. Like we all drive Tesla cars. We all have like huge fan of Elon Musk, but because it's such a hype FOMO, Elon Musk is like the marketing guru. He creates all this hype, right? So every time the hype is up, I sell. Every time people are like, Tesla sucks, I buy. And we've been doing this for 3 years.
So Kiana, we've talked about how you pick stocks. Tell us how you would recession-proof or market crash-proof your portfolio. What would you do?
So one of my main methods, after I've picked the assets that I want in my portfolio, be it cryptocurrency, be it Forex, ETFs, index funds, whatever it is that is suitable for my portfolio and my risk tolerance, I then set buy limit orders, because even for me, it's very hard to not fall for the trends. Because I mean, you go on Facebook, you go on TikTok, you go wherever, people are talking about it. It's very hard to manage that emotion. So in order for me to do that, and also, I mean, I'm a mom, obviously, I cannot be stuck to my screen anyway all day. To do that, I set my buy limit orders and my profit targets ahead of time. I do technical analysis long-term, not a day trading technical analysis, long-term, right? And I identify the key psychological levels with these two tools that I use, Ichimoku and Fibonacci. These are technical analysis tools. And the combination kind of shows me the key psychological levels. And then I go to my broker. I set them like literally 3 months ahead. And it's interesting that I go back to my portfolio, I go back to my charts like 3 months later, 6 months later, and the key psychological levels really have stayed the same. And as the market goes up and down, my buy limit orders go through. So this is basically emotion proofing, because recession proofing, what recession really does, it brings out emotions, and the emotions is what drives the prices to go up and down. That's what really drives the price. The valuation of the company doesn't go up and down, the market sentiment goes up and down. So setting it ahead of time, doing the analysis ahead of time, is going to keep you from being stuck to your screen all day. It's going to keep you from getting emotional. You have your journal as to why you set these buy limit orders, and then you let it go. So in March, when COVID happened, I wasn't like investing. We saw something is happening. We already knew a recession was coming even before COVID. And I already had my buy limit orders, and they went through as the markets dropped. I wasn't even at my desk when it happened.
Another interesting fact that you brought up to me offline is that there's a new type of investors coming into the space, mostly women, mostly mothers, and you're seeing a lot more. Your InvestDiva website used to be dominated by male subscribers, but now you're seeing a lot more women enter the space. Why is this significant?
So this is significant for me personally, because when I founded InvestDiva in 2012, my mission was to help women actually, to start investing. And that didn't really feel like it was happening, because for the longest time, 90% of my students were men. And I wasn't like excluding them. It's fine if you want to pay me money, it's fine, I'll take your money. But it really didn't feel like I was leading this mission, I was fulfilling the mission. And when COVID happened, I feel like my story suddenly started resonating with them. I became a mom, and then I have this probably in the background. And then women suddenly realized that, oh my gosh, things cannot be taken for granted. Things can really change in the blink of an eye. Like, Kobe suddenly died. Like, a lot of things happen. And I feel like women suddenly realize that they have to be in charge of the financial future. And since March, it's amazing. Suddenly, I saw this flow of moms pouring into my website and starting investing and making a ton of money. Now, 86% of my students are women, which is just amazing. I'm just super grateful for that.
So this trend that you're noticing, do you think it'll drastically change the investment landscape? Is there a difference in approach to investing between a female trader or a male trader or investor?
Yes. So this is actually not on me. The research after research actually shows that, has been showing it for years, that women are actually better investors than men because they don't get into investing or trading to win a game. They're not driven by testosterone. They're driven by something bigger, like long-term, supporting their offspring. So when they come in, which is what's interesting is that even though they say women are more emotional, the emotion that actually drives women to make decisions are perfect for investing. So they make a little bit more calmer decisions. When they lose, when there is a losing trade, they don't go back in immediately to make up for that loss. They sit back and go study something else. So because of the nature of women always wanting to do personal development and things like that, and not in it to win it, women make longer term investors and less risky investors. So if there's a ton of women in the landscape, that I feel like we probably will see less volatility in the markets, because the market sentiment is not going to be pushed up and down as much. But I mean, of course, then we still have the male traders who are going to push it anyway. So I don't know how the landscape is going to change, but I'm pretty sure a lot of women are going to be banking on that.
Okay, so Kiana, I guess where can people find out more about your work and learn more about your trading strategies?
So yeah, I have a free training actually on my website, investdiva.com, that I walk people through the steps that I take to select an asset and to create the buy limit orders that I talked about before, and my Japanese system. So I think that would be an amazing place to start for somebody who's just getting started.
Perfect. Thanks very much, Kiana, for coming on the show and giving us your insights. Appreciate it.
Thanks for having me.
Thank you for watching Kitco News. I'm David Lin. Stay tuned for much more.